Running a business is tough, and navigating the complexities of tax compliance can add another layer of stress. But what if you could streamline this part of your operations? Stay with us as we cover 10 essential tips to keep your business compliant with Nigerian tax laws, ensuring you stay out of trouble and focus on what you do best. Staying compliant isn't just about avoiding penalties, it's about creating a stable foundation for your business. Let's dive into these crucial tips. Tip 1. Understand the obligations. Knowledge is power. Familiarize yourself with the types of taxes applicable to your business, whether it is value-added tax, company's income tax, or capital gains tax. Knowing what you owe is the first step to compliance. Tip 2. Register for taxes. Every business must be registered with the Federal Inland Revenue Service and the State Internal Revenue Services. Ensure you have all necessary tax identification numbers. This isn't just mandatory, it's also beneficial for processing any tax credits or refunds. Tip 3. Keep accurate records. Document every transaction, no matter how small. Accurate record keeping not only simplifies your tax filing process, but also protects you in the event of an audit.
Gone are those days where it never matters. You have tax obligation as a secondary issue. You can't afford to do that anymore. In fact, one of the issues that can threaten your going concern as a business is tax default. If you don't handle your tax obligation very well, it can lead. It's a roadmap to going concern challenge. So, as a company, as you are strategizing towards your purchases, as the case may be, towards your finance, towards your personnel and the lives, you must also have on top of the table your tax obligation. Depending on the size of the company, you could do it alone. Depending on the size, a nano, a micro business, you don't have the money to hire a tax consultant. But I tell you, as you expand, you need to do this if you can't get an in-house tax manager or regulatory manager, as the case may be. So it is with the support of your tax manager or regulatory manager, if you can have an in-house one. Otherwise, you hire a consultant who can do that on your behalf. It is with that arrangement in place that you can do a good tax planning. And we all know what tax planning is. It is just arranging your activities within the dictates of the law in order to take advantage of certain things, certain steps. You know when to spend and what to spend on. You know those expenses that once you incur them will be allowable. You are allowed to take them from your turnover or income, as the case may be. And very important, many of the taxpayers and some of my colleagues actually fall foul of the law in this area. Tax is not sentiment. It is what the law says. So you don't expect the revenue officer to assume that you are a saint. That is not his business. He's not looking for a saint, neither is he looking for a devil. He's looking for a tax responsible citizen, either as an individual or as an artificial person. So if you are a tax responsible person, one of the things you must not fail to do is documentation. No matter how small, you must always document, because you rely on your knowledge and you think in 6 months' time when the tax man comes, or 6 years' time when he comes, because it's within the power of the administrator to come even 6 years after, to come and look at your book. And you think, okay, because it rained in Lagos in 2022, that was the reason why I didn't have this document. That will not survive. So, in your compliance strategy, documentation is key. You have a meeting with the revenue officers, and you get back to your office. Dear SYC, in line with our meeting today, please note the following as my understanding of our agreement. let them acknowledge, put a copy in your file. How that letter will save you in another 2 years, you may not be able to imagine. If you are moving, maybe the company is temporarily closing down, and you believe you can't be in business for the next 6 months, but hopefully what I'm expecting in another 10 months will bring us back into business. Now, don't assume that FRS or revenue agencies are aware of that your crisis. Write a letter to them immediately that as a result of the following, we are informing you that we are winding down or slowing down or reducing the activities of the company. Hopefully, the moment we get better, we get you involved. Let that letter be acknowledged, put it in your file. It will save you in future. These are little things that people may not pay attention to, but I see as part of your planning that we ensure that you comply. And of course, the people in the revenue agencies, even though we may have our differences because their focus is different, they want to maximize revenue, while the taxpayer wants to minimize tax obligation.
Tip 4. File and pay on time. Late filings and payments can lead to fines and penalties. Keep a calendar of due dates for all your tax obligations to avoid these unnecessary costs. Tip 5. Deduct correctly. Understand what expenses are deductible and keep meticulous records of these deductions. This reduces your taxable income legally and efficiently. Tip 6. Use technology. Leverage technology to manage your taxes. Many software tools are designed specifically for tax compliance and can automate much of the process, reducing errors and saving time. Tip 7. Stay informed about changes. Tax laws can change. It's crucial to stay updated or consult with a tax professional regularly to ensure your business adapts to new laws and regulations. Tip 8. Separate personal and business finances. This simplifies record keeping and ensures personal expenses don't mistakenly become part of your tax filings.
This is what happens mostly when we are dealing with the small businesses. It's peculiar to them. And why do I say that? I've mixed with a lot of them. And I will say that a lot of them don't have that skill and understanding. But what some of us do is to advise them, to guide them so that they don't mix. Once you do that, you are already exposing yourself to avoidable liabilities. Because you need to start explaining what that fund is for. It's not for business. It's personal. My brother sent it to me. My sister said I should buy a shoe. It's my sister's money. It's my mommy's allowance. Why save yourself? Why not save yourself that explanation? It's always better to have separate accounts. If you're doing a business, anything you're doing as a business, do it in the business name. Anything you're doing as an individual, you have your personal account before you even started running business. Don't go and say they should set up your business account as your personal part of your personal account. No, set up a new account. Nothing stops you. The only difference is that because you're setting up a business account, the requirements will be different. They might need your certificate of incorporation. They will need your TIN registration. They will also need your evidence that the directors have paid their taxes, because that's also an area that people run away from, so they go and use personal accounts, you know. And you will also be able to use it to track the transactions related to the business. For instance, there was a time that I had to speak to FR some time ago when they had a friend had a problem. She's a distributor and she was mixing everything together. So they just took all the credits, 5%, and said, come and pay VAT. I said, bah, it's not done like that. Why don't you look at what is in this account? Did even some narrations, money from Auntie Yabo. It's not, okay, you may not know what it is for. You may say money may mean anything. Okay, fine. Who is Auntie Yabo? Oh, she's my sister. And you confirm that. So don't mix it up. Let it be clear that this is sales of sugar, sales of spaghetti. Let it be clear. So your narration is also clear. You might even separate financial record, but you are using wrong descriptions. That's also another issue. When you are using description that is confusing or could be misinterpreted to mean a sale, then you put yourself into trouble. So you must be very clear in your narration. If it is personal transaction, let it go to your personal. If it is business, if it's an advance payment, put it advance payment for this. Sales invoice, and you can say payment for supply, sales invoice 124. So it is clear. So you can match your sales invoice to what you collected. Because when you have reviews for the tax authorities, they want to check that you have included everything, full and no false inclusion, complete inclusion. At that point, you can say, all this money in my bank account that are credits, this is what the invoices relates to. The debits are my purchases. These are the invoices I got from my vendors. And with that account is a replica of what you do. The moment you start to mix personal funds, then it becomes a problem. Let's assume you took a loan. You should not go to your personal account. If it's for the business, then you put the loan in the business account and say loan for working capital. When repayment terms, you have an agreement that says your repayment and you keep that. So it's always good to separate the two. So you don't have issues with misinterpretation of your transaction. You don't have issues with unnecessary tax liabilities that you can avoid. You don't have issues with even you thinking of what is which is which, and trying to struggle with reconciliation. So you reconcile every account separately. If you like don't reconcile your personal account, it's your personal problem. But the business account must be properly reconciled so that you can show good costs for your transactions. You show accountability, you show transparency, and then you'll be able to smile when the taxman comes knocking at the door.
Tip 9. Consider professional help. Even if you're confident in your ability to manage your taxes, consulting with a tax professional can provide insights and spot issues you might miss. Tip 10. Plan for taxes year-round. Instead of scrambling at year-end or tax deadlines, integrate tax planning into your regular business strategy. This proactive approach can uncover ways to save and avoid the year-end rush. Following these tips can transform tax compliance from a dreaded chore into a manageable part of your business strategy. Stay proactive, stay informed, and watch as your business reaps the benefits of full tax compliance.